Now let us look at how to do valuation. So the second question, uh, whenever these mergers are happening, amalgamations are happening, demergers are happening, buyback is happening, delisting is happening, split is happening, stake acquisition is happening, how in all these cases valuations are done. So primarily there are three approaches which are used for the purpose of valuation in case of all these different forms of corporate restructuring. So what are these approaches? So basically we need to understand this from two perspectives. Number one is to what is approach, and number two, under each approach there are certain methods. So what we have, the first we have income approach. So if Reliance is going to divest its shares, or Reliance is going to acquire any other company, or if there's a merger happening of two banks, or demerger happening of Kotak, or any of those situations, there are three approaches that can be used, and number one is the income approach. As the name suggests, income approach means what? It simply means that the basis under the income approach for the purpose of valuation is nothing but the income of that business. And that is how it is known as income approach. Under the income approach, there are two methods. Method number one is income capitalization method. So under the income capitalization method, what would you do? You will find out income of a company, normalized income of a company, and you will capitalize it by your cost of capital. And this is how you will find out value of an entity which is in the process of M&A. The other approach under the the other method under the income approach is the discounted cash flow method. Now, discounted cash flow method, in my view, is the most authenticated, most dependable, most reliable method of valuation, and this, in my view, should be used in every case without any exception. Even if even if in certain cases the quoted price may be prescribed, I would always feel that discounted cash flow is must absolutely. More so in case of the companies which are coming out with IPOs. Now, in the recent past, we have seen so many debacles as far as the IPOs were concerned. We saw the IPO of Paytm. Company came out with a public issue of 2,150 rupees, and today that share is languishing at about 600 to 700 rupees, in the range of 600 to 700 rupees. That means someone who invested, a retail investor who invested a huge amount of 2,150 rupees, is now left with a huge loss of about 1,500 rupees. And unfortunately, he cannot sell it also, because to book such a loss can really be devastating for a retail investor. So therefore, uh, in all such cases, in all such cases, I would very strongly recommend, it may be difficult, it may be complex, but use the discounted cash flow method, because it is highly unlikely that the valuation done based on discounted cash flow method will go wrong, so long as you are being sensible in making your assumptions while calculating your cash flow and while taking your discounted rate or your risk rate. And how do you do the discounted cash flow? Of course, it is very simple. You project your cash flow for the future, and discount that cash flow for the future. D- uh, Discount that cash flow of the future with your cost of capital, and the sum total of the present value of all the years will be your value of that company or value of that asset. So that's a discounted cash flow method. And I would like to repeat once again, please, please, please use discounted cash flow method whenever you're doing any valuation. Market approach is fine to support it. Asset approach in any case will give you the lower end of the valuation. It will not give you the real value of a company. Asset approach is to be used only in cases where the company is going in for liquidation. In all other cases, either you have to use discounted cash flow method or your approach, or you have to use discounted cash flow method, or you can use the market approach for supporting your discounted cash flow, or vice versa. Under the market approach, broadly you have two methods, comparable company method and comparable transaction method. What is the difference? Difference is very simple. How do you find out the value? You find out the value of a company which is getting merged or demerged or being bought over or being taken over by applying the comparable company method or by applying the comparable transaction method. Comparable company method would mean that has there been any transaction of a company which is comparable with your target company. If those valuations are available, use those valuations as the reference or the valuation for this company, with some edits here and there depending on the dissimilarities between the two companies. So when you are trying to find value of a company by comparing with another company, it is known as comparable company method. When you're trying to find value of a transaction by comparing with the value of another transaction, that is known as comparable transaction method. Under the income approach, what you have, you got a different methods available, because there are so many variations or variances, variations available of these methods. But broadly what you have four methods. One is book value method, which means you simply take the value as given in the balance sheet. Second is adjusted book value method. That means what? Don't take the book value as it is, make adjustment that you may be aware of as far as the current value of those assets or those liabilities, and this is how you find out the value of that company. Replacement method, as is what it is. That means in case if you are trying to do the valuation using the replacement method, that means ये जो asset है, इसकी जो current situation है, इस सिचुएशन में अगर इसको रिप्लेस किया जाए, ऐसी किसी एसेट से रिप्लेस किया जाए, तो वो एसेट को क्या कितनी वैल्यू होगी, एंड दैट इज योर replacement method. And finally what you have is the liquidation value method, and which means a company which is going in for liquidation. So अगर उस कंपनी की एसेट्स को बेच के कितना पैसा मिलेगा और वो एसेट्स को बेचने में कितना खर्चा जाएगा, उसको माइनस करने के बाद जो आपके हाथ में आता है, that is known as your liquidation value. I would once again like to repeat, friends, and you must make a note of it. Income approach, and under the income approach, the discounted cash flow method is most fundamental, most dependable, most reliable. Ignore it at your own risk. So tomorrow, if you happen to do the valuation, tomorrow if you happen to be associated with any M&A anywhere, and if you need to refer the valuation, make sure that the valuation that are done are based on the fundamental and not otherwise. Quoted price is okay. Under the market approach, you also use the quoted price. So in case if a company is listed on a stock market, then the price quoted on the stock market is taken as the value of that company's share, and multiply with that number of shares, that becomes the market cap of that company, or the total value of that company. Now quoted price, friends, in my view is okay, but it should always be cross-checked with discounted cash flow method. And why do I say this? And that is because there are hundreds and thousands of examples available, which I am sure all of you would also be aware, where once upon a time a company was quoting at a very high price, and today that company is being quoted at a very low price. One example that comes to my mind is Suzlon. Suzlon, I remember once upon a time was quoting at 1200 rupees, and today that company is quoting at 12 rupees. So somewhere something has gone wrong, and what has gone wrong in my view is to use not a fundamental method of valuation, which is the discounted cash flow, instead of using some flowery technique or method for finding out the value. And that is how you end up getting into a situation like Zomato, or like Paytm, or like so many of them, or like Reliance, or like LIC. Interestingly, friends, and I am sure you should know this, LIC was an issue which was managed by 14 merchant bankers, And these 14 merchant bankers arrived at the value of LIC, and the 911 rupees was supposed to be the issue price, and today it is somewhere around 600 and plus. Now, what has gone wrong? I mean, this should be analyzed. This should be analyzed. And why it should be analyzed? Because merchant bankers चला जाता है, कंपनी चली जाती है, वैल्यूएशन करने वाले चले जाते हैं, लेकिन जो रिटेल जो इन्वेस्टर है, जो झटका खा चुका होता है, he loses his confidence not only in the capital market but also in himself. And that something is something which has to be avoided at any cost. At any cost. And finally, friends, what we have the asset approach, which is also known as cost approach. Under that, you have got 4 different methods, and there can be too many variations of these methods that I am sharing with you. It is good mostly in case of liquidation. It only gives you the downside value, and that is what we need to remember. So friends, we have understood as to how is the size of the M&A globally, Asia and in India. We have understood as to how is the scope for M&A in India, and we understand it very clearly, because despite the fact that we are in a VUCA world, but the fact that India's economy is on a very strong footing, we see a huge amount of M&A. And please remember, M&A is a post thought. No one starts company to merge in with another company. M&A is a post thought. But even if it is a post thought, yet there is a huge scope for M&A. And why there is a huge scope? Because there may be 2 entities making profit, creating value. But when these 2 entities combine together, they will make more profit, they will create more value. And therefore, even though these 2 companies are making profit, creating value, yet if these 2 companies combined together can create more value, which is more than the total value created by both these companies individually, then why should that not happen? And therefore, there's a huge scope for M&A and valuation in this country. And of course, that will and we understand very well that valuation is an integral part of any M&A activity. As a matter of fact, valuation is an integral part of any corporate decision anywhere taken in the globe. Now, let me quickly share with you, friends. We also have Index 113, which is on fair value measurement. Every company in this country which is having a net worth of 250 crores or above, or a company which is listed on a stock exchange anywhere in India or outside India, or any company which is in the process of getting listed, either is equity or is debt. And of all these companies that I've spoken to you, ये सारी कंपनियों की joint की holding company, the subsidiary company, joint venture and associates, all of them have to today prepare accounts based on the indices, right? And one of the indices that is there, which is Index 113, which is on fair value measurement. Fair value measurement, of course, is applicable in case of M&A also. It will be applicable in the context. It will be applicable in the context of valuation, and it will also be there is another index which is 103, and that is on business combinations, which will be applicable post merger or demerger or amalgamation or takeover or acquisition. So there are 3 methods which are mentioned by the Index 113: income approach, market approach, and the cost approach. These are same as that I have discussed with you. Only thing that you must remember that in case of M&A or otherwise, Index 113 does not prescribe any method that you have to use this method only or that method only. No, it is up to the valuer who is doing the valuation of that entity or that business. Yes, Index 113 prescribes 3 input label. So level 1 input means what you use the quoted price. Level 2 input would mean you use the observable information or data, and level 3 input would mean unobservable inputs. Now इसका मतलब क्या है? इसका मतलब ये है लेवल वन इनपुट का मतलब ये है कि अगर आप ऐसी कंपनी का वैल्यूएशन कर रहे हैं और ऐसी कंपनी का मर्जर कर रहे हैं, ऐसी कंपनी का अमलगमेशन कर रहे हैं, ऐसी कंपनी का टेक ओवर कर रहे हैं, ऐसी कंपनी की डीलिस्टिंग कर रहे हैं जो कि लिस्टेड है, ऑफ कोर्स डीलिस्टिंग विल हैपन ओनली ऑफ a listed company. In such case, what you have to use level 1 input. That means use the quoted price as the basis for valuation. In case of an entity is not listed, then Index 113 will prescribe label 2 input, and label 2 input would mean comparable data, right? Comparable data. So that means there is a company which is not listed, but there is a company of a similar type which is listed on the stock market. Then the quoted price of the listed company can be used as reference for the valuation of this unlisted company, which is similar in every aspect or most of the aspect as the listed company. And then you have level 3 input. Level 3 input would mean where there is a company which is, say, private limited company. You are merging a private limited company, or you are merging a public limited company which is not listed. So how do you do valuation? You cannot use the level 1 input because they are not listed, so quoted price is not available. You also cannot use the level 2 input because it would be very difficult to find a comparable company of a private limited company, and therefore the market comparable data may not be available. Therefore, what is the option that you have in such a case? The option that you have in such a case is to use the level 3 input, and that is use the discounted cash flow method.